All right, guys, welcome to the day 13 of this teaching. And it has been a long ride. We have had 18 different teachings, sorry, 12 different teachings before this one. And I would like you guys to go and watch the previous videos from the 1 down to the 12, and then you can come over here because this topic is the build up to the previous topic, right? And don't forget that these videos will be deleted on the 30th of November 2023. The reason is that on the 1st of December, we are refurbishing our paid mentorship. So we'll be adding this 30 days teaching to the paid mentorship videos. All right. So for now, today is the 14th day of October 2023. So you have enough time to watch this from now till next month 30th. That you have a month and about 2 weeks to watch this. And that's a lot of time if you ask me. Even if you're watching one video per day, you'll be able to finish it before November 30th. So if you're just joining us, do have to go to the previous video and watch these videos 2 times. Watch it as many times as possible before coming over here, because on the November 30th, we're taking these videos down and transferring it to our paid mentorship. So if you'd like to um, make the most of this while it's available, use this time is available now. All right. So let us go to a very important topic. We have talked about market structure. We have talked about break of structure, change of character, inducements, liquidations, all the for those fun stuff, right? So now let us start going to the institutional side of trading, right? So we understood market structure, all those external or technical standpoints. We just have to look at what the logic, right? There's a difference between technical analysis and the logic behind the technical analysis. So it's one thing to understand technical analysis, no BOS, no those arbitrary concepts, right? But you have to also understand those the logic or the reasoning or the framework behind all we are learning. All right. So let us talk about the basic elements to an instruction. All right. So these are the four things in which you can use to identify what the institutions are actually doing or what an institutional trade setup is. So an institutional trade setup is a setup that is sponsored by a bank, it's sponsored by a big fund, or is sponsored by a large entity, right? Because the market moves based on liquidity, right? Based on the liquidity provided. So the market cannot move unless money is pumped into it. That is why on a holiday, you tend to see the market stall because there is no liquidity in the market at that given point, right? So liquidity, apart from the technical standpoint, liquidity is where people put their stop orders, while from the institutional standpoint, liquidity is the money that is being pumped into the market. And there's an estimate that the financial market has $6 trillion in it day in, day out. That means that about $6 trillion in the financial market. So that's what we refer to as liquidity. So now if an institutional if an institution is in the market or is doing a trade, there are basic things that you should look out for to spot or to understand what they are doing, because most times they're either hedging, right? They're either hedging the market, that's consolidating the market, or they're expanding the market, or they're reversing the market, or they're taking markets back to where the fee market should go, right? So now you have to be able to identify the basic elements to an institutional trade setup. So there are just four of them, the things that you need to know that an institution is setting up the market for a certain thing. So the first thing you should know is that we have what we call the um what we call the consolidation, right? So it's a very important one. So you have to understand what's consolidation, right? So now the institutions are either doing any of these four things. Number two, they are doing what? They are in an expansion, they're expanding the market. So the market is either in a consolidation and expansion. That's the second thing the market can be in. The third thing the market can be in is what we call a retracement. The market I will teach you, don't worry, just follow me. You really have something to go home with, right? Don't worry. Just follow me. All right. So now these are the four setups that you will find in the market when an institution is sponsoring the movement. Right? There are just four of them: consolidation, the expansion, the reversal, and the retracement. Right? Shout out to ICT. I learned this from the inner circle trader. And it's something that really helped me to scale up my trading, right? So I learned this from the inner circle trader. So kudos to ICT. All right. So now The basic elements to an institutional trade setup are very simple, right? You have to identify what the market is doing, right? Is the market consolidating? Is it expanding? Is it retracing or is it reversing? Right. So now let us start with the first one, which is what we call the consolidation, right? So now for the consolidation, um, the market is typically in a range, right? So consolidation is characterized by a range, right? So you usually see what a range, right? So market is ranging. So you see what a range, right? And the key feature, or let's say the key reference, right? There's something you have to look at to just know what to do. Okay, now what do you do with consolidation? And the key reference is the risk reference point is the equilibrium, right? So the key reference point of your range is what the equilibrium, right? Equilibrium. That's the key reference point. Don't worry. Don't worry, I will give you a life example. So the key reference point of a range is what? The equilibrium, right? So I didn't spell that correctly. Equilibrium. If I'm not mistaken, it should be correct. All right. If I'm not mistaken, equilibrium. All right. Bro. Oh my God. This spelling has everything. It's really very confusing. It doesn't make sense to me get. So the key reference point in a consolidation is what's the equilibrium, right? So let us just have a better understanding of what am I talking about. So when the market is ranging, that's the first thing when you come to your chart, the first thing you should do is to zoom out. Right. Once you zoom out of the chart, right, you're able to identify this. When you come to a chart, maybe an euro-dollar chart like this, which I'm showing you in a moment, the first thing you should do is to zoom out. Just zoom out and understand the market. Just take a bird eye view, right? And now, if the market is in a kind of range, then the market is in a kind of box, right? It's not like it must be perfectly boxed. The market is in a kind of boxing movement, right? It's not really trending. Right? The market is in this kind of box. So you simply do what you box the whole move, and remember that the most accurate way of defining a range is by using the body of the candle. So you can use the body of the candle because the body of the candle contains most of the volatility of the candle, all right? So you can just simply box the candle or box the area, use the bodies of the candle, and then what do? You plot 50% of it. So you can bring out maybe a Gantt box or a Fibonacci and then plot 50%. So the 50% is where you look at for the market, right? So the 50% is where you're looking at the key reference point. So when the market is in its consolidation phase, you simply mark the 50% out. Then usually when the market is about to move, it usually does what? It breaks out and then comes back to test 50% before they was moving higher, right? So this 50% area, you look out for what? An other block that is around that area. So this area is what you're looking at. So when the market breaks out of the consolidation of the range, the 50% is where you look at for, and you look at for what? An order block, right? So an order block is what to look at for at the 50% of your range, right? So you look for an order block that was created when the market broke the range. And most times, if the market is bullish, the market is bullish most times, it usually goes down first. Take out liquidity, then run higher, and then come back to the test and then goes run higher. So usually the market is wanting to go higher. It usually does what? Liquidates the low first before they was coming back to another block inside the 50% range and then it was running higher. So this is what a range actually looks like you want to um if you want to look at it from this standpoint, right? So the range is usually the starting point of every move, and usually you will find this during the Asian session. If you open your chart and look at the Asian session, you usually see this range occurs. So this range typically occurs in the Asian session for intraday trading. So if you're an intraday trader, you usually find this range formed in the Asian session. Why if maybe it's a high time frame, it can be on the high, it can also happen on the high time frame, right? So it can be the thing about high time frame is that if you are in a daily range, you will not really feel it because the movement is very, very large. But if it's a lower time frame range, then it's easy to spot. If this range now is occurring on a daily chart, you wouldn't really feel it because this movement will be a lot because it's on the daily chart. But if it's something like 1 hour or 15 minutes, you can actually spot the market was in the range. So you must know that the market can be in a consolidation phase, and the key reference point is with the equilibrium. And the equilibrium becomes important when the market breaks away from that range. So once the market breaks from that range, then the 50% becomes what? An area of interest for you. So that's the key reference point when you're defining a consolidation or a range. So from an institutional perspective, whenever you're taking a trade, you're looking at for what? The 50% whenever you're what? In a range. All right. Don't worry. I will go to life examples after now. I'll just run to life examples so you can get a better feel. But just write this down. This is why you should have a notepad, because I want to talk about all of them before going to examples. So first, the best thing you can do now is to write this thing down on a piece of paper, so that when I start giving life examples, you can reference back to what you have written and to get a better understanding of what I'm talking about. So simply write it down. Okay, this is equilibrium. You just take a screenshot, put it in your notepad, and then when I go to the life examples, then come back and compare what I just talked about with the life examples. All right. So let's go over to the next thing. So we have talked about the consolidation, and the next thing we have to talk about is what? I also talk about the next one, which is what? An expansion. So an expansion simply means a trending market. So market is expanding when it's doing what? It is trending. This is what we call an expansion. So when market is trending, right? That's what we refer to as an expansion. Market is doing what? It's going higher. This is an expansion. Market is trending higher. Right? This is an expansion. So this is an expansion. This is what it looks like. So market is not in the range. Market is doing what? It's expanding. It's going higher or lower depending on the trend of the market. So an expansion is characterized by what? A trend, right? It's characterized by what? A trend. Characterized by a trend. So expansion usually occurs from the range. So when markets finish consolidating, let's say expect what? An expansion. And the area you're looking at for is what? The order block, right? So you know expansion is usually an order block you're looking at for. So when market expands from that range, remember the first thing we went to is what? The range, right? This is the range. These are boxy range. Remember this is a range we had. The next thing you usually see was the market will start to expand. So when the market is done with these boxing movements, the market will do what? It start to expand out of this range, and then it goes to the first as what? An expansion. So you're looking at other blocks in this system. So remember that the 50% you're looking at for. So remember, the market breaks that range and start expanding. You look at for the 50% of the 50% of the range or this, and then can now take price higher. So the market can actually look this way. So the key points and an expansion of other blocks, right? So other blocks become an area of interest, other blocks become area of interest on this kind of move. So you're looking for other blocks, the market to tap into and then continue going higher or lower. So other blocks become an area of interest in this market. Other blocks become area of interest. So you're looking at other blocks and all of this fun stuff, right? Look at other blocks. So other blocks are area of interest when it comes to expansions, right? Yes. So you look at other blocks, right? Other blocks, right? So you look at other blocks when the market is expanding. It's very, very easy to spot. So whenever the market is expanding, it's trending. You're looking for other blocks to get filled. And some of you that like this demand and supply, looking for demand and supply zones. Remember, the market is expanding. You're looking out for what other blocks and demand or supply zones. So if you use demand and supply, you know what to do. If you're using other blocks, you still know. If you're using key levels, you still know what to do, right? But typically, I use other blocks or demand and supply levels. That's what you're looking at. The market is expanding. You're looking for what the other blocks created that has not been mitigated, right? So that's what you're looking at for in an expansive movement or order flow. So order flow can also serve as well. So remember, I taught you guys order flow. I think in the last two teachings, I talked about order flow, right? So expansion is just look for order block to catch your trades, right? It's just order blocks you're looking at for nothing else. Not for order blocks, right? Just order blocks, that's all. Just look for order blocks. That's all. Just look for order blocks. That is it. So that is basically what we're looking for expansions, order blocks, right? Now note something. When the market is in a consolidation phase, remember, now let me just talk a bit about this. When the market is in this phase, this consolidation phase, you are not doing anything. You have to wait for the market to break out. Now, if that range is on a higher time frame, maybe the market is in a higher time frame, right? If maybe it's on a higher time frame, right? You can now, if maybe it's a daily chart, you can look out for what buys at the 50%. The market comes into the 50%, you can look for buys. If you can't wait for the market to break out of the range, then the area you can look at for is what market. The market comes 50%, you can look out for trades, but it's very, very advisable that you wait for the market to break out. So for the sake of this call, I don't encourage you to trade ranges because it can get very nasty. You can get, don't worry, in the moment when I start showing you guys examples, you will see why I said it can get very nasty. So consolidation should not be traded until it breaks out of the consolidation and start expanding, right? So the next thing we're talking about now is what? The retracement. So retracement is simply when the market has finished expanding and it's coming back into what? An area of interest. So now when the market is expanding, maybe it's bullish, right? This move higher is what we call what? An expansion. So we can put that as what? Expansion. The move higher is what we call expansion, and the move lower is what we call a retracement, right? So the move down is what we call a retracement or a pullback. So this move down a reversal, while the move up is what we call an expansion, right? So we call the move up an expansion, and the move down was a retracement. So this move up because of the expansion, the move down because of your retracement, right? So you for what? This market come back and then you want to take price was higher, 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 higher. So that is basically what you're looking at for. So for a retracement, there are two key reference points in the retracement. You're looking at for two things. Number one, you're looking at for what? Liquidity voids, and fair value gap. So when market is retracing, there are two things you look at for. You look at for what? Liquidity voids and what? And fair value gaps, right? And fair value gaps. No, I will explain this as we continue. Don't worry, just write it down. Just write it down. So the market is retracing. You want the market to come back into what? And a fair value gap or a liquidity void, right? So that's pushback is what you're looking at for. All right. So you can market to come back to what? That fair value gap or what? That. All right. So give me a moment. All right, guys. So a liquidity void or what? A fair value gap. That is the area of interest for a retracement. So remember, market is retracing. Don't worry. Check the description of this video. I have done a teaching of this before. That was about 4 months ago. I will still post the link so you can go to that teaching. I talked about this before, but this is just to give more light to what I've explained before. So you can go to the previous teaching. I talked about this concept before and get a better feel for what I'm doing. So when the market is expanding, looking out for what liquidity voids and what fair value gaps, right, to get filled in. All right, that's basically what we're looking out for in this example. Right? So let's talk about the next one. So I can go to live examples. So that's the key reference point. Don't forget the key reference point is what? The fair value gap or the liquidity void. So just move that out. Remember, you should be writing in this market, in this example, you should be writing. You know, like I don't want to do, you should be writing these things down. And then the final one is what we call a reversal, right? So for a reversal, the key element to a reversal is what we call what? A liquidity pool. So reversals typically happen when the market takes out the kind of liquidity pool, maybe so equal highs here. So when the market grabs that liquidity, so the as the reversal. So when the market takes out that liquidity, I've told you about liquidity, maybe equal highs resting here. When the market takes out that liquidity there, that's what we call a reversal. So this move higher, that becomes the reversal. Market can usually do take a liquidity pool, then what? Reverses. So market does that, then reverses down. We call it the reversal. So the area of reference for a reversal was the liquidity pools. So when market take a liquidity pool, expect a reversal of some sort. Right? It can also be a kind of trend line. Market is in a trend line. Right. So you can expect a kind of movement, right? Market take a liquidity pool and then was reverses higher. So the market does it a lot. This is a reversal example. Market is just doing this, and then what happens? So the reversal, right? So the market takes a liquidity pool and then what reverses higher. So that's where so look out for areas of liquidity when you anticipate reversal, especially this kind of reversals. It can also be in form of what a single top, just like this. Okay, take out the liquidity pool, just like this, run higher and then drop lower. So just take out the liquidity pool here and then drop lower. Also referred as a reversal. So these are setups in which you can take. So market take a liquidity pool. If maybe you're bearish, you can expect the market to reverse down. And this is what we call the reversal setup. A reversal. Market taking a liquidity pool, then reversing down. I actually call this trade on EU. So let us now go to live examples to have a better feel for what the market is doing. All right, so now let's go to live examples of this whole stuff. Right, this was the first one, which was the consolidation and the expansion, because they go hand in hand. So let us go to recharts now. Okay. All right. So look at what I'm talking about. So look at this now. Very typical example of what I'm talking about. Look at this. Let's take a look at this. So the market was doing what? Consolidating here. So watch this. So use the body of the candles to mark the consolidation. So the body of the candles is what we look at when you're marking what a range. So market was ranging in this box. Right. So that's the range of the box. You can see how the body of the candles were in this box. Right. So We saw the 50%. This is a 50% of the box. So what happened? The market what? Broke out. Where was the other block that was created because this breakout, right? So now what do you see here? Look very carefully. This is the other block, right? So can you see what I'm talking about? And the block is what? Around the 50%. So you can see what I was telling you guys about, or just teaching you guys about. Remember to go to to that video or the beginning part of this video where I talk about the key reference points in the consolidation, right? So you can see the market was in a range. What happened? It broke out. Remember that when the market is in a range, you do not know. Also during the Asian session, right? So the market broke out. What happened? It came out of what? That key reference was the other block, right? And I actually caught this trade. So you can check my Twitter on my Twitter page or my Telegram. You can see I actually caught this trade. It's actually on my Twitter and my Telegram. So you can see the market do what? I had this range. This is an institutional setup. Market broke away from the range. What happened? Came back into what the other band was created was by that breakout. So that other block created by the breakout is what we refer to as the key reference. Because the market was consistent and that was an expansion, right? So the market was consistent was an expansion. So this key element is also referred to as what? The key element for what? A consolidation and an expansion. So a consolidation and an expansion typically go hand in hand. So market will range and then 50% will break out and then come back to the other block and then you take your trade from the other block. So you cannot take a limit or you do what? You wait for a lower time frame confirmations around that 50% of what the range. So this is a very typical example of what I just explained earlier. And let's go to the next one, which is what's it called? The retracement. So retracement simply means in my talk about that the key element for retracement was the liquidity void or the fair value gap, right? So in this market now, we broke this range. Now, where is the retracement? So market was bearish. So the market was breaking this low. Market broke this low very clearly. So the market breaking this low, right? That was now we have now moved from what a consolidation to what an expansion leg. And this was during what the London session. That's when this move happened in the London session, right? So what do we have here? So what do we have here? So we had the market break. Then what do we have here? We had what this the pre-London low. So market open. This was a London low. Market formed a pre-London low here. So market was now coming back up. This was a London low. So we now enter the New York session somewhere around there. We enter New York somewhere around there. This is New York session somewhere around there. So enter New York around there. That was the New York session somewhere in New York. So now where is the fair value gap? Right? So I had the fair value gap here. So look at this fair value gap right here. So I had the fair value gap here. Right, so this is the fair value gap. Can say market do what? Played it nicely. So nice fair value gap. And don't forget that we had what if a breaker block here. So we had a breaker block aligning with what that fair value gap, right? Don't worry, I'll teach you guys about breaker blocks. Don't worry, I'll teach you guys about that as we continue. Right? But for the sake of this call, we had a breaker block here, which align with what this imbalance, right? So if you took your sales here and maybe stop above this higher imbalance here, you'd have gotten involved, or maybe you sold it and then stop above this swing high here. So that would have been a very nice trade for you. All right, so you can see how the market, when the market is retracing, you look at for fair value gaps or liquidity voids. Right, so liquidity voids are similar to fair value gaps in that liquidity void is simply when you see huge candles. Look at the liquidity void there. This liquidity void, this big space. You can see market creating big candles in one direction. When you fair that also refer to as liquidity void. So this is liquidity void now. You can see this big gap, right? This big gap where it was only sales. So the liquidity void is very simple. You can see liquidity void all the way from here, all the way down to this point, right? So this is liquidity void all the way here because we had only sell candles there, right? So you can see that the last buy candle stopped around there, right? This is the last buy candle stopped. So this whole area is a liquidity void. Liquidity void simply means when there's only one silent movement, like only sells, only sells, only sells, only sells, only sells. There was no bullish candle here. There was no buy momentum here. So this was liquidity void. So markets usually retrace to come and do what? Fill liquidity void. So this is an area of reference. So market can come to what? Fill liquidity void. So usually wait for market to fill liquidity void before doing anything. So liquidity void is very nice. But in the sake of this example, market did not fill liquidity void. Maybe to do that next week. And for this sake, market speed was the fair value gap, right? So you should anticipate the market doing this kind of things. All right, it does this a lot. So let's talk about reversals. So look at the reversal here. What do we have here? We have this liquidity here. So what do we have here? We had was this high here. This is a very sweet one here. What do we have here? We had was this Asian high here. That's liquidity here. Market took out Asian high. So what happened? Market took out the high. What happened? Market took out this high. What it do was drop. So this was as a reversal. So this move here is a reversal. So you can see the market took out this liquidity pool. Hit about that block here. And what? Drop down. So this is everything lining up what for itself. So a reversal appeared here, a liquidity, a retracement appeared here, and also an expansion and a consolidation phase appeared here, right? So this happens a lot on the markets. You can always see this occur on the market. So let's look at another pair to see if we can spot any of all these things that I just mentioned, right? So let us look at this another pair, right? So all right, so look at something here. We had what a kind of typical range here. Where's the range? So market was ranging between this high here was your what kind of range here? That the range was in the bodies of the candle. So this is the body of the candle. So this was the range I can find. Because the market was ranging in this box. So what happened? The market broke away from this range. What happened next? Was there, let's mark 50% of the range first. Let's mark 50% of the range. Let us mark 50% of the range. All right. So this is 50% of the range. All right. So was there other block here? Let's see. So for me, this is the other block here. All right. So the market did not really tap into it. All right, but that was other block here. So this is what we felt as a range. Market was on a range. What happened? Market broke out, then came back, and then it was running higher. Market may still come back there in the future. Right? So that is an example of the instrument setup from the ranging aspects. So we usually find these things occur in the markets a lot, right? So let's see another range. See another range here. I see another range here. That was ranging between this high and this low. So I had this range. I had this range here. We use a bone of the candle. This is a range of the market, right? So it was a reversal setup, right? So markets actually do what? Broke below the range first and then broke higher. So in this example now, where that becomes our area of interest in this other block, in this range, right? So looking for another block around the range, right? So you can extend this down, you can extend um this last down to the future. Then that was another block, right? So this was after the range was taken out. This was the other block that was created after the expansion, right? The market was in the range, then they broke out of the range and then expanded higher. So this becomes the other block. But markets broke above, it's led this other block confused. Markets came out with this other block and then was round back higher, right? So even if you want to use the other block, you can still use this one, but this was they actually kind of took out that broke the range. You can also use this one. So you can use this single other block here, this one here. You can also use this as another block, right? So you're still very correct because it's still what around 50% of the range. So you can either use that or use this hold down push. Right? You can also use it as the other block or this hold down push, right? So you can do that. That's what the market of course. It's just very nice you spot these things on your own, right? So look at the reversal setup here. You can see the market was the market took out this liquidity down here. You can see equal lows here. The market took out this reversal lows and then was run higher. You can see the market always take a liquidity put. So you can see it happens. So look at this liquidity pool here. This is what called reversals. So you can see this liquidity pool here. See this low. Market took out that low. What happened? Reversal. Market took out what happened? A buy. So you can see how reversals happen. And then let's look at for let's see if we can see a kind of fair value that was filled, right? So now look at a very simple example of see that reversal here. Market took a liquidity point was around higher, right? This occurs very much on the market, right? It happens a lot, happens way lot, right? GA doesn't really give fair value gaps, doesn't really give fair value gaps. But I can see fair value gap here. So you can see markets keep the balance this fair value gap and do what? Run higher, right? You can see liquidity void here, you got liquidity void here. We had only sell candles from here all the way down here. So I had only sell candles here. This was the liquidity void. So you can see the market was came to feel this was where the void stopped. So you can see the market came to feel this void. So you can see how the void was filled because what we had only sell candles there. So this was what we called a liquidity void. The market came to feel the void and then what dropped, right? It filled the void and what happened next? It dropped. So when you're using your voids, once the market fills the void, expect some kind of reaction, right? Like I said earlier. So when the market fills your liquidity void, expect some kind of reaction to the downside or to the upside, depending on the market direction, right? So the best thing you can do is to go and watch the previous video I did in 3 months ago. The link will be in the description so you can have a better understanding of what I'm talking about. So you can also compare that with what I've taught here for your learning, right? So I hope to see you guys in tomorrow's teaching. Do not to backtest this information. I will see you guys in tomorrow's teaching Tomorrow will be more of psychology. Talking about risk management tomorrow, because Sundays are for psychological discussion, right? So tomorrow is Sunday, so do what to hop on, talk about risk management as the secret of what consistent growth, right? So I think I should end there. Have a wonderful day. Do what to like this video, subscribe, and then recommend this video to your friends, right? So have a wonderful day. Cheers and God bless.